debt they'll allow to go.
Yeah, that's right.
Too much strategy out there. Okay, so now we come back to the break. First of all, who knows the answer to the trivia question?
LT.
Not me. I don't watch baseball.
Was it Lawrence Taylor?
You're gonna say that. You're gonna say that.
I always get the comic relief if I can't copy off of Mark's answer sheet.
Yeah, that's right, exactly. That'll work. Okay, then Neil will introduce you, and okay, now the questions. Did you guys get a chance to download the questions?
I have some questions of my own as well.
Okay.
Yeah.
All right. And Mark, any specific questions you have or want?
I do.
Okay. Oh, okay, good.
Yeah, I'm just gonna throw out some.
All right.
I'm gonna wing it.
Ready?
When you guys are.
Yep. Okay.
All right, 12-minute segment, 11-minute cut. Mike's hot, 5 seconds of silence.
Well, welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money and Brian Burke of Praxis Capital. When we cut to the first commercial break, we asked this trivia question. Joe Theismann suffered a career-ending compound fracture by this Hall of Fame linebacker from the New York Giants. Who made the hit? Brian, what's the answer?
I don't know. I don't follow baseball.
He doesn't follow baseball. Mark, what was the answer?
Was it Lawrence Taylor?
It was Lawrence Taylor. Very good. Okay. We are in the studio. We have been blessed with Neil Hennessy, who is a seasoned portfolio manager with over 30 years of financial industry experience. Neil has has a successful history acquiring asset management companies and starting mutual funds. He's recognized and respected asset manager who is ranked among Barron's top 100 mutual fund managers in 2003 through 2008, and he'll tell us why it hasn't continued through or past 2008. Neil, welcome to the Best of Investing.
Thank you.
Okay. Now, first of all, we were just mentioning in your bio here that you've been ranked very highly 2003 to 2008. And we all know what happened after 2008 with the market in general, but you were telling us earlier what happened after 2008.
Well, Barron's used to do the top 100 managers in the country on a risk-adjusted basis. And after 2008, it really didn't make any sense at that time because not only did all the markets fall apart, not only the equities, but the bonds, the munis, the whole 9 yards. It was very tough to put any kind of numbers together, and we know what happened in 2009, 2010. And even looking today, you have the volatility in the marketplace that's going to make it very difficult to be looking at those numbers going backwards. And so going forward, so maybe it'll pick it up in the next couple of years if we get some more or less volatility.
Okay, well, let's get into directly your mutual fund, because it is called Hennessy. Now, the thing is, you have more than one mutual fund.
We have 9.
You have 9 of them, okay.
Depending on your risk tolerance.
Okay. How much money do you have under management?
Approximately $800 million
okay.
when I left the office.
Depends on how the, well, let's see, today's Saturday, so the market's already closed. Okay, and load or no load?
They're all no load, so there's no commission going in or commission coming out.
Okay, and after I ask this last question, I'll let you guys chime in. What kind of expenses, because obviously you can't work for free.
Well, I think the whole expense ratio is blown way out of proportion because when you look at a mutual fund every day, it closes with a net asset value, and that is minus all expenses. People look, Morningstar would be there and say, for instance, our funds are expensive because the total expense ratio, all in, including accountants, attorneys, paper, prospectuses, SECs, filings, management fees, custodian, administration, transfer agent, go on, is about 1.25%. But what's interesting is there's a lot of articles that are written about mutual funds, how the expense ratios have gone up over the years, and it's true. But it's not because management fees have gone up. Ever since we've been in business, our management fee hasn't gone up. But postage has gone up, the accountants have gone up in price, the attorneys have gone up in price, printing's gone up in price, you just named it. So we can't control those expenses, but the expense ratio of the managers have not gone up, and the reason being it takes shareholder vote to do that.
And what is that portion of the management fee?
Well, normally it's anywhere between 60 and 75 basis points, so you're talking a little over 1/2% to 3/4% is what we get paid, which isn't a whole lot of money unless you start to build, a large asset base.
So Neil, we've just had, we're ending a year of just amazing market volatility. How are your investors reacting to that, and what are you telling them?
Well, you know, it's interesting. Up until August 4th of this year, there wasn't a day where the Dow Jones closed up or down over 300 points. Since August 4th, we've had 13 days where the Dow Jones has closed up or down over 300 points. The volatility is scaring the investor to such an extent they don't know what to do. And what's happening is they're moving their money out of equities because they don't see it as safe. They don't believe the market's going to make them money. And they're putting it into bond funds or fixed income. And it's the worst possible place they could go, because if you look at it logically, I'm not an economist and I'm not an analyst.
But you're a smart guy, though.
Huh?
But you're a smart guy.
In my own mind.
Yeah.
But essentially, when you look at it, how much lower can interest rates go?
Yeah.
They're at zero. So the idea is they're going to go up. And I know nobody wants to say this, but you know, you look at PIMCO, Bill Gross, he had a 32-year bull market. Interest rates went from 21.5% to zero.
Mm-hmm.
So the odds are in the future rates are going to go up. If rates go up, bonds react opposite. People are going to lose their money, and that's just going to really throw them to the wolves, because they're just completely lost. And I, you know, you can't really blame them, because they got in March of 2009 they got a double whammy. Not only had they lost half of their assets in the market, the one thing that they all knew they had in their back pockets, if anything went wrong, was the equity in their home. And they saw that diminishing on a daily basis, and that hasn't got any better, and that's what's hurting consumer confidence.
You know that you mentioned about the bond funds, that can be kind of a double whammy too, because if I understand it correctly, because as interest rates go up, not only do the prices drop, but if you suddenly have a quote run on the bank, now you have less new money coming in buying higher interest rate bonds.
Well, I mean, if you look at the financial institutions, the banks, they're borrowing from the feds at zero right now. If rates go up, their margins are going to get squeezed. Because right now, you know, you go to a bank and you get a loan, you're going to get a 6% loan. Well, they're borrowing at zero. But if rates go, the Feds moves it to 2%, it's going to be tough for the banks to charge 8%. They might get 7.5 or 7, so their margins are going to get squeezed going into the future.
So it sounds like maybe even investing in financial sector stocks is maybe even a questionable strategy too, or is it? Is there a safe haven there?
I don't think it's a, you know, it's a safety issue. If you go back to the beginning of how this whole event happened, I look at it, and my opinion is when John Thain at Merrill Lynch, who was president of Merrill Lynch, sold all of his real estate paper, all of his mortgage paper at 22 cents on the dollar, everybody had to market. Those are the accounting rules, the last trade. And so when you look at when Merrill Lynch did that, they took down everybody else, because although at that time people were paying their mortgages on time 96% of the time, and then it went down to 92%. But the paper certainly wasn't worth 22 cents. But if you had to market on your books at 22 cents, you were out of business.
That's a big hit.
And if you look at it logically, because I know I hear on the news all the time, and I see Washington, the politics going on, you know, the taxpayers bailed out the banks and Wall Street. Give me a break. Because the banks paid all that money back, $250 billion in less than a year. Now, if the banks were that bad off, how could they pay back $250 billion in a year after tax?
Right.
Absolutely.
Tell that to the occupiers. They seem to think they still have it all, don't they?
And didn't the government get a piece of that action with the preferred stocks?
This is a real sad part of that whole story. And that is, it was a TARP program. All the money that was loaned to the banks, when it was paid back, was supposed to go back in the TARP to pay that back off. And it was a $750 billion package. Congress still hasn't paid it back. So although the taxpayer made a tremendous amount of money, anywhere between 8 and 11% on their money just on the interest of the loan plus the warrants, the money's still sitting out there and the taxpayer's paying interest on that money. Because they said, well, we might need it in the future. But the whole crux of the deal was, as soon as B of A gave the money back, or Citi or anybody gave the money back, it went back to pay the debt down.
They can always just put a little gasoline and just churn out more money if they need it, rather than pay interest on it.
Yeah, you would think so. So, you know, a lot of this volatility seemed to get started once all the real estate debacle hit a number of years ago, but it seems like lately there's a lot of volatility caused by people just trading on European news. Is that really what's taking place? I mean, especially what happened this last week.
Let's get real. I mean, you got to look at things in a common sense and logical way. Can any one of you guys tell me here right now when the Europeans got anything right?
1066, the Battle of Hastings, William the Conqueror.
So
I think we had a
Brought all the
historian.
clans together.
the bottom line here is Greece, Italy, a lot of these countries, they have to do exactly, and the United States is going that way too, is they're gonna have to do just like any corporation does. They're gonna have to restructure their debt. Some people are gonna take a hit. You might get 60 cents on your dollar, or 70 cents, or 50 cents, but somebody's gonna take a hit. It was an investment, you lost money, go on. But you look at the Greek situation, 70% of the people in Greece don't only pay any of the debt back. Just said, forget it, we're not gonna pay you anything. And that'd be great, everybody would lick the wounds and go on, and Greece would just be dead, because who's gonna go to Greece? Nobody, and the only thing they have attracting people is tourism. So they'd be dead, so they gotta figure out a way of restructuring this debt.
I don't know, Neil, it's all Greek to me. Okay, so let's get a little levity in here. I understand that you have a, this came up to me here. Do you follow Buffett's Berkshire performance, and what do you think of Buffett's record, and suggest that you tell your Buffett joke, but clean up the punchline for our listeners?
Well, first of all, I'm not sure what joke that might be, and I'm not gonna get in trouble with the FCC, but Warren's had a stellar track record. He really has. And the money just keeps compounding. And one of the interesting parts about it is they can put the money out as it just, they had $50 billion, they went down to 22 billion, or back to 30 billion, 40 billion, and then they put 10 billion out, and it just keeps building upon
It's just
itself.
a holding company.
Yes,
Right? It doesn't do anything.
and they've done very, very, very well. And he's of the opinion, and rightly so, that when you invest in the stock market, you invest in a company, you invest for the long term. And I don't care if it's the company or if it's real estate. We got into the game of no money down and flipping homes and trying to do all this, and that game didn't work out. So if you buy quality and hang on to it for the long term, you'll be fine.
Yes. Yeah. Okay, we are going to cut to our second commercial break. We're in the studio with Neil Hennessy, who's the mutual fund manager of Hennessy Funds. And here is our second trivia question. In 1978, Darrell Stingley was paralyzed by this raider, aka the Assassin. Who made the hit? I'll give you a hint. It was not baseball, Brian. But also, here's another hint. He was also involved in the Immaculate Reception play, if you remember that one. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. In 1978, Darrell Stingley was paralyzed by this raider. He used to play for the Patriots, as I remember, aka the Assassin, who made the hit. Hint, he was also involved in the Immaculate Reception. Call 888-912-1190. Make sure to include your name, address, email address, and phone number, and we will be right back.